Welcome back to TalkTickers, listeners. Today we're going deep on Agree Realty's Q3 2024 earnings call.
All right.
Got the transcript here, obviously.
Yeah.
We've got their latest stock performance, some recent news articles.
Yeah.
Plenty to unpack.
A lot.
And get ready for a wild ride through the world of retail real estate.
Buckle up.
Because trust me, it's way more exciting than you might think, especially with all the market volatility we've been seeing.
What I find fascinating is how Agree Realty just seems to be like dancing through this economic rainstorm,
Right.
While everyone else is struggling to stay afloat.
Yeah,
Their stock is actually up over 2% today,
it is.
which is quite a feat considering all the election jitters and inflation worries we've got going on.
It's definitely a head scratcher.
Yeah.
Markets are acting a bit haywire.
Yeah.
Agree Realty is sitting pretty.
Mm-hmm.
So what's their secret sauce? How are they thriving in this environment?
Well, it all comes down to their strategic approach.
Okay.
They're using this volatility to their advantage. Instead of panicking, they've been proactively raising capital, bolstering their balance sheet, and get this, using that capital to acquire properties at increasingly attractive prices.
So they're not just weathering the storm.
No.
They're using it to grab prime real estate.
Exactly.
That's brilliant. And speaking of capital, how much are we talking about here?
Hold on to your hats because we are talking serious money.
All right.
They've raised almost $500 million in forward equity this quarter alone.
$500 million?
$500 million.
That's impressive.
It is, and that brings their total available funds to almost $2 billion ready to be deployed.
Wow.
Forward equity essentially means they've secured commitments from investors for future stock issuances.
Okay.
So allowing them to access capital very quickly when opportunities arise.
Gotcha.
It's a very smart move in a volatile market like this where timing is everything.
So they've got this massive war chest, but they're not just throwing money around, right?
Absolutely not. They're incredibly selective about their acquisitions.
Right.
Focusing on what they call high-quality retail properties.
Right.
These are properties with strong tenants, long-term leases, and locations in areas with solid demographics.
So we're talking about those household names.
Yes.
The retailers that are pretty much recession-proof.
Exactly. Think Walmart, TJ Maxx, Home Depot, those types of tenants.
Got it.
And here's where it gets even more interesting.
Okay.
With cap rates on the rise,
Yeah.
Agree Realty is getting better deals than ever.
Now, for those who aren't familiar with real estate lingo,
Sure.
can you break down what cap rates are and why rising cap rates mean better deals for Agree?
Of course. So a cap rate or capitalization rate is essentially the rate of return expected to be generated on a real estate investment property.
Okay.
When cap rates go up,
Yeah.
it means property prices are generally going down relative to their income.
Gotcha.
So you're getting a bigger discount on the same item, essentially.
Okay, so they're being picky about the properties they buy.
Yep.
They've got billions of dollars ready to invest,
Mm-hmm.
and they're taking advantage of rising cap rates to get those properties at a discount.
Exactly.
That's a winning combination.
It is.
And to illustrate their strategy, let's look at a specific example.
Yep.
The Big Lots situation.
All right.
Remember how 2 of their stores went bankrupt recently?
Yeah, that was big news in the retail world.
Yes, it was.
Well, Agree Realty saw an opportunity there.
Okay.
They purchased one of those leases outright and quickly released it at over 150% higher rent.
Wow.
Yeah.
That's an incredible turnaround.
It is.
They took a potential loss and flipped it into a major win.
Exactly.
That speaks volumes about their ability to identify opportunities and act decisively.
It does.
They're not just buying properties, they're actively managing their portfolio to maximize returns.
Mm-hmm.
That's impressive. It seems like they're always one step ahead, anticipating market shifts and finding ways to capitalize on them.
Yeah. They are, and their proactive approach doesn't stop there. You know how construction costs have skyrocketed lately?
Oh, God, no, it's been a nightmare for anyone trying to build anything these days.
Well, Agree. Realty has turned that challenge into an opportunity.
Oh, really?
They're stepping in as developers and lenders, providing much-needed financing to retailers who are struggling to build new stores.
So they're filling a gap in the market.
Exactly.
Helping retailers get their projects off the ground and strengthening their relationships with those key players all at the same time.
Yep.
It's a brilliant strategy.
It is. It gives them a significant advantage in the market. And it's not just about providing financing. They're also deeply involved in the development process, ensuring that the new stores are designed to meet the evolving needs of consumers.
That makes sense. Consumer behavior has changed so much in recent years, especially with the rise of online shopping. Retailers need to adapt, and it sounds like Agree Realty is helping them do just that.
Precisely. And this ties back to their overall portfolio strategy. Remember, we talked about how they're focused on high-quality properties?
Right.
Well, part of that quality assessment involves understanding the long-term viability of the retail sector the property serves.
So they're not just looking at the building itself.
Nope.
They're analyzing the entire ecosystem around it.
Exactly. They're considering factors like demographics, consumer spending habits, and even the competitive landscape. And this brings us to another crucial aspect of their strategy, managing tenant risk.
Okay.
They're incredibly selective about the sectors they invest in, deliberately steering clear of those that have been hit hardest by the pandemic and the shift to online shopping.
Like full-service restaurants, for example.
Exactly. Restaurants have been struggling, and Realty has recognized that. Instead, they're focusing on what they call non-discretionary and non-experiential retail.
Okay, so those are things that people need, not just things they want.
Right, we're talking about essentials like grocery stores, drugstores, tire and auto service centers, and home improvement stores. These are the types of businesses that are likely to remain resilient even in tough economic times.
Makes sense. It's like they're playing a game of chess, carefully anticipating their opponent's moves and positioning themselves for long-term success.
That's a great analogy. They're not just reacting to the market, they're actively shaping their portfolio to align with the long-term trends they're seeing in consumer behavior.
This level of foresight is incredible. So with all this in mind, what are some of the specific sectors they're particularly bullish on right now?
Well, they've been very vocal about their confidence in the grocery-anchored sector.
Okay.
They see it as a stable and growing market, driven by the essential nature of groceries and the increasing popularity of online grocery ordering and pickup services.
So even though people are buying more groceries online, these physical stores are still crucial.
Absolutely. They serve as fulfillment centers for online orders and provide a convenient option for those who prefer to shop in person. Agree Realty has been strategically acquiring properties anchored by leading grocery chains like Kroger, Publix, and Wegmans.
Okay, those are all well-established brands with loyal customer bases.
Yeah.
And I imagine the shift to online grocery shopping has actually benefited those larger chains, giving them an edge over smaller competitors.
You're absolutely right. And Agree Realty is capitalizing on that trend. They're also seeing strong growth in the discount retail sector, with tenants like Dollar General and Five Below performing exceptionally well.
Oh yeah, those discount retailers have been popping up everywhere. It seems like there's one on every corner now.
There's a reason for that. In uncertain economic times, consumers tend to become more price conscious, and discount retailers offer an attractive alternative to traditional department stores. Agree Realty has been actively acquiring properties in the sector, recognizing its resilience and potential for continued growth.
So they're balancing their portfolio with a mix of essential businesses and discount retailers, both of which are well-positioned to weather economic storms.
Exactly. And they're not just focusing on acquiring existing properties.
Right.
Remember their development and developer funding platforms we discussed earlier.
Right, the ones where they're helping retailers build new stores.
Well, they're using those platforms to further enhance their portfolio, ensuring that their properties are modern, strategically located, and tailored to meet the evolving needs of consumers. They're even investing in innovative technologies like solar panels and electric vehicle charging stations, positioning themselves as leaders in sustainable real estate development.
Wow, they're really thinking long-term, aren't they?
Mm-hmm.
It's like they're building a portfolio for the future.
They are, and that's one of the things that makes them so impressive. They're not just reacting to the market, they're actively shaping it. They're identifying long-term trends, anticipating shifts in consumer behavior, and making strategic investments that will position them for continued success.
I'm incredibly impressed by their strategy. They're clearly playing the long game, and it seems to be paying off in a big way.
It is. In a market where many are struggling, Agree, Realty is not only surviving but thriving.
Yeah.
And that's a testament to their disciplined approach, their focus on quality, and their ability to adapt to changing market conditions.
Yeah, it's truly remarkable to see a company navigate these uncertain waters with such expertise and precision.
Right.
They're not just surviving, they're thriving. And that really makes you reconsider the possibilities in real estate, even in a challenging market.
Absolutely. And I think what sets them apart is their deep understanding of the underlying trends, the shifts in consumer behavior, and their ability to anticipate and capitalize on those changes.
Right.
It's not just about the numbers, it's about having that foresight.
Exactly. They're not just reacting, they're shaping the market.
Yeah.
So what's the key takeaway here for our listeners?
Yeah.
What can we learn from Agree Realty's success?
I think the biggest lesson here is that in times of uncertainty, a strategic, disciplined, and opportunistic approach can be a real game changer.
Okay.
Agree. Realty is proving that even in a volatile market,
Yeah.
there are opportunities not only to weather the storm, but to emerge even stronger.
Yeah, it's inspiring to see a company that not only talks the talk, but walks the walk.
Couldn't agree more. They're a shining example of how a well-executed strategy can lead to impressive results, even when faced with challenging circumstances.
So to wrap things up, Agree Realty's in it for the long haul. They're making smart moves, building a portfolio that's designed to endure, and frankly, their performance makes me want to check out some of their properties myself.
I think that's the mark of a truly successful company.
Yeah.
When they not only generate returns, but also inspire confidence in their approach.
Well said. And on that note, we'll leave you with this thought. Think about the stores you visit regularly. Which ones seem to be doing well and which ones are struggling?
Yeah.
Makes you wonder, doesn't it, about the future of retail and which companies will come out on top.
Food for thought, indeed. Thanks for joining us on this deep dive into Agree Realty's remarkable Q3 performance. Until next time.
Happy investing, everyone.